Okay, so today let's do something quickly in taxation. As you can see in front of me, I have a topic today that I want to talk about, the capital allowances. So the capital allowances, we are saying capital allowances are a form of tax relief given for capital expenditure. I'm sure you understand the term capital expenditure. So capital expenditure is not an allowable deduction in the computation of taxable business profits. Okay, so this statement means we don't deduct capital expenditure from the business profits. Okay, but I'm not talking about capital expenditure. There's a difference between capital expenditure and capital allowances. So capital allowances are not given on all types of capital expenditure. The Income Tax Act contains the types of capital expenditure on which capital allowances may be claimed. The qualifying expenditure includes expenditure on implements, plant and machinery, industrial buildings, commercial buildings, farm works and improvements. These mentioned and a few are the ones where capital allowances can be claimed. Okay, so we are saying capital allowances are available on qualifying capital expenditure incurred wholly and exclusively for the purposes of the business. For the purposes of the business. Okay, the allowances available are written here. Here I want to highlight the rates or on the capital expenditures. How much can you claim on these capital expenditures here? Okay, so on implements, plant and machinery, the rates according to taxation legislation in Zambia is at 25%. Then we have any machinery used in manufacturing, tourism and leasing, 50%. And then we have used in farming and agro-processing, 100%. Commercial vehicles, meaning vehicles not used for private purposes, the allowance is 25% claimable. And then non-commercial vehicles, personal to order vehicles, we are saying is 20%. Okay, so I hope you follow through my reading just for the introduction, for you to get an idea where we are going. We will do a few of computations for you to understand. Okay, so let's do this question. The question reads, Mulenga, who has been in business for several years, owns equipment that he acquired a year ago at a cost of 20,000 kwacha. At 1 January 2020, the equipment had an income tax value of 15,000 kwacha. So the income tax value is the value left for Mulenga to keep on claiming capital allowances on this asset. Okay, it's 15,000 kwacha. During the tax year 2020, Mulenga bought a Nissan car for 23,000 kwacha. It has been agreed with the Commissioner General that Mulenga's private use of the car is 25%. There were no other assets owned by Mulenga on which capital allowances could be claimed. Required, calculate Mulenga's capital allowances for the tax year 2020, showing clearly the income tax values at the start and end of each charge year. So the computation will look like this. You say here Mulenga computation of capital allowances on implements, plant and machinery. Charge year 2020. So this is how it's going to look like. The capital allowances will be written this side, and then here we are going to have the income tax value brought forward. So for the equipment, the income tax value brought forward in 2020 is 15,000 kwacha. Then how do we calculate the wear and tear allowance, which is 25% on equipment? You calculate 25% on the cost of the equipment. The cost was 20,000 kwacha. So 25% is the 5,000 kwacha. You deduct from the income tax value. Yes, you calculate here, and then you bring here the capital allowances figure. So this is the income tax value brought forward. You subtract your computation in that current year, which is 5,000 kwacha. The income tax value balance comes to 10,000 kwacha. So you go to the next. The Nissan car was just purchased in 2020. It doesn't have the income tax value yet. So it's the cost appearing here. Purchase cost, as you can see, is 23,000 kwacha. Then you calculate the wear and tear allowance on the Nissan car. Depends, is this a commercial vehicle or is it a personal to order vehicle? The rates are there that I read earlier. So 20% times the cost, which is 23,000 kwacha. Why are we calculating on the cost? Why is the cost appearing in the income tax value balances? Because this is a new non-current asset. So the value comes here. 4,600 was the capital allowance calculation. But here is the 75%, because it was agreed that this asset is used 75% for the business purposes and 25% as a private vehicle. This is the reason we are multiplying again with 75,000 kwacha to come up with the actual capital allowance claimable. So this is the total capital allowance